Most people think they need a lot of money to start investing. But the truth is, what matters most isn't how much you start with. It's how early you begin and how smartly you build. In 2025, opportunities for beginners have never been more accessible, yet so many people are still sitting on the sidelines, scared of losing money or not knowing where to start. This video is your full roadmap. A clear, no-nonsense guide to understanding how investing really works, how ordinary people grow wealth step by step, and how you can build financial freedom even if you're starting small. Let's start with the truth that most financial influencers won't tell you. Investing isn't about getting rich overnight. It's about creating a system that makes your money work for you even while you sleep. The people who build true wealth don't chase quick gains. They build consistent habits. Whether you're in the United States, the UK, India, or anywhere else in the world, the core principles of investing are the same. Spend less than you earn, invest the difference in assets that grow over time, and let compounding do the heavy lifting. In 2025, investing is more accessible than ever. Commission-free platforms like Robinhood, Charles Schwab, Fidelity, eToro, and others have opened the doors for millions of beginners to start investing with as little as $10. But accessibility doesn't always mean success. Many beginners start buying stocks without understanding the risks, and one bad experience can push them away for years. That's why your first step isn't buying anything. It's understanding what investing really means. Investing is simply using your money to buy assets that generate more money. Those assets can be stocks, bonds, ETFs, index funds, real estate, or even businesses. But the principle is the same. You're giving your money a job. Now, let's talk about why investing matters. Inflation is silently eating away at the value of your money every single year. In the US, inflation has cooled down from the highs of 2022, but still averages around 3% in 2025. That means if you keep your money sitting in a bank account earning 1% interest, you're actually losing 2% of your purchasing power every year. Investing is how you fight back. It's how you ensure that your money grows faster than inflation, protecting your future self from the financial stress your present self could prevent. Every beginner should first understand the three pillars of investing: time, consistency, and mindset. Time is your greatest ally. Even small amounts invested regularly can turn into a fortune if you start early. Consistency matters more than timing the market. And mindset is what keeps you calm when everyone else is panicking. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Remember that every time you feel tempted to sell too soon or chase quick returns. Now, if you're starting in 2025, the best place to begin is with index funds and ETFs. These are collections of stocks bundled together, allowing you to own small pieces of hundreds of companies at once. Instead of betting on a single stock like Tesla or Apple, you can invest in an index fund that holds them all, like the S&P 500 ETF, ticker SPY or VOO. Historically, the S&P 500 has returned about 8 to 10% per year on average over the long term. That might not sound like much, but compounded over 20 or 30 years, it's life-changing. If you invested $200 a month with an average 8% annual return, you'd have over $225,000 in 30 years, from just $72,000 in total contributions. That's the magic of compounding. Your money makes money, and then that money makes more money. But what about risk? This is where most beginners struggle. The truth is, all investing carries some risk, but there's a difference between calculated risk and reckless risk. Calculated risk means understanding what you're investing in, diversifying your portfolio, and having a long-term horizon. Reckless risk is betting your savings on one meme stock, a random crypto token, or following hype you don't understand. The way to manage risk is diversification, spreading your investments across different asset classes and regions. Don't put all your eggs in one basket, even if that basket is shining right now. Another key principle for beginners is investing in what you understand. If you don't understand how a company makes money, you have no business investing in it. The same goes for crypto, real estate, or any asset class. You don't have to be an expert in everything. Just know enough to make informed decisions. Start simple, learn as you go, and never invest based on social media hype. Let's break down a simple beginner portfolio strategy. You can divide your investments into 3 main buckets: equities, stocks, fixed income, bonds, and cash or cash equivalents. If you're young, say in your 20s or 30s, you can afford to take more risk, so you might go 80% in stocks, 15% in bonds, and 5% in cash. If you're closer to retirement, you'll want more stability, maybe 60% in stocks, 30% in bonds, and 10% in cash. The idea is to balance growth and safety based on your personal timeline. In 2025, one of the smartest ways to invest is through automated investing platforms, also known as robo-advisors. Platforms like Betterment, Wealthfront, and Fidelity Go create diversified portfolios for you automatically, based on your goals and risk tolerance. They rebalance your investments periodically, reinvest dividends, and keep your portfolio on track. For beginners who don't want to spend hours researching, this is one of the most effortless ways to start. Now, let's talk about the emotional side of investing, something that most people underestimate. The stock market isn't just numbers on a screen. It's a mirror reflecting human emotion, greed, fear, hope, and panic. When markets crash, beginners often sell in fear, locking in losses. When markets boom, they rush in late, buying at the top. The best investors learn to control their emotions. They stick to a long-term plan and trust the process. Remember this rule: time in the market beats timing the market.
For those with a slightly higher risk appetite, 2025 is also a year where emerging markets and AI-driven tech sectors present strong opportunities. But again, don't chase trends blindly. You can add a small percentage of your portfolio, say 10%, to thematic ETFs like AI, clean energy, or blockchain technology. These allow you to participate in future innovation without putting all your money at risk. If you're outside the US, don't worry, the same rules apply. Whether you're investing through the UK's ISA system, India's mutual funds, or Europe's ETFs, the basic principle remains. Start small, stay consistent, and reinvest everything. The global financial system is interconnected, so US trends often ripple worldwide. When the Federal Reserve adjusts interest rates, markets across Asia, Europe, and the Middle East react. So, even as a global investor, it pays to stay informed about US policy and economic data. Let's talk briefly about dividends, one of the most underrated forms of passive income. Dividend-paying stocks and ETFs reward you with regular cash payments just for holding them. Reinvesting these dividends is one of the fastest ways to grow wealth. Think of companies like Johnson & Johnson, Procter & Gamble, or Coca-Cola. They've paid dividends consistently for decades, even during recessions. A dividend reinvestment plan, DRIP, automatically buys you more shares every time you get paid, amplifying your compounding power. Taxes are another aspect beginners must understand early. In the US, you have tax-advantaged accounts like Roth IRA, traditional IRA, and 401k. These allow you to invest while minimizing or deferring taxes. If you're in another country, explore your local tax-advantaged options. Using these accounts effectively can save you tens of thousands of dollars over your lifetime. Wealthy people don't just make more money, they structure their money more efficiently. Now let's address the elephant in the room: crypto and digital assets. In 2025, the crypto market has matured but remains volatile. Bitcoin and Ethereum are still relevant, but they should never form the foundation of a beginner's portfolio. Think of them as speculative side bets, no more than 5 to 10% of your total investments. Learn the basics, understand the risk, and never invest money you can't afford to lose. Long-term, blockchain and tokenization might play a major role in finance, but your foundation should remain strong, diversified, low-cost, and long-term focused. Finally, remember that investing is not just about money, it's about freedom. Freedom from worrying about bills, from living paycheck to paycheck, from feeling like your future is uncertain. When you invest, you're taking control of your future self's choices. Every dollar invested is a step toward independence. The earlier you start, the easier it becomes. You don't need luck, you need discipline. The most powerful force in investing isn't the market, it's your behavior. If you've made it this far, you're already ahead of most people, because the first step to wealth is understanding how it's built. Whether you're starting with $10 or $10,000, what matters is starting today. The market rewards consistency, patience, and education, not luck. So build your foundation, invest with purpose, and let time do its magic. If you found this valuable, make sure to subscribe to Wealth Hub, where we simplify finance, investing, and wealth creation for everyone ready to take control of their future.